All right, welcome back, Terpinators. Welcome to this week's Taxes and Retirement Live, where we'll be talking about tax loss harvesting and tax gain harvesting. Sound similar on the surface, but are slightly different. So let me start things off with the dad jokes for the week. Joke one. Took an airline company to court today after my luggage went missing. I lost the case. Joke two. My partner and I can never agree on vacations. I want to go to exotic islands and stay in five-star hotels. She wants to come with me. It's like Rodney Dangerfield, or who was it? Henny Goodman, maybe. I take my wife everywhere, but she keeps finding her way home, or something along those lines. Yeah, in the same vein. And finally, I got mugged by 6 dwarves yesterday. Not happy. Because Happy was missing. He was not one of the 6 dwarves to do the mugging. He was grumpy and dopey and sleepy and sneezy, etc. All right, comments are working good. First comment from Cody Garrett, CFP. Cody Garrett, CFP, ladies and gentlemen. Congrats again, Cody. And Terrence Lamb, I see, dropping a comment. So good, comments work. As always, feel free to post comments, questions along the way. I will get to them as the flow of the discussion permits and as I notice them. Let me start with the disclosure, which is now, as you notice, a mandatory or built-in part of this presentation each week. This video is only general explanations and education. It's not specific tax, legal, or investment advice. Before considering acting on anything you see or hear here, first consult with your tax, legal, or investment advisor. All right, thank you. Shauna saying hi. Thank you. Hi, Shauna. So one thing to know at a high level, and this tax loss and tax gain harvesting are one of probably the more technical things we discuss in the group. I'm sure many of you feel lots of this stuff is technical, but I feel like this is one of the potentially more advanced things. For what it's worth, not next week, in a few weeks, October 7th will be one of the more introductory presentations. I'll be going over the basics of the 4 different account types, Roth, tax deferred, regular brokerage, and I'm throwing in HSA as a 4th type. Consider that like a one-on-one level class, if you will. I know most of you all in the group are kind of DIYers who are pretty well versed in this stuff and come here for the more sort of next level education, but there's also others who are relatively new or know the basics. So some of the stuff I realize is a bit technical. So I want to sprinkle in some stuff that kind of brings things back to the basics, which hopefully you all will get something out of. So anyway, October 7th will be the summary of the 4 accounts. The reason why I bring that up is because tax loss and tax gain harvesting only applies to one of those types of accounts. Specifically, it's the regular or normal or taxable brokerage account, meaning it's money that you fund with regular after-tax monies, just like monies you would put into a checking or savings account or something. That's what we call a normal or regular or after-tax brokerage account. So tax loss and tax gain harvesting applies to those accounts and those accounts only. Does not apply to Roths or traditional IRAs or HSAs, because not to get too ahead of October 7th presentation, but anytime you buy or sell anything in any of those 3 accounts, there's no tax implication at the time. In theory, you can buy and sell unlimited amount of things and times throughout the course of the year in those accounts, and it won't matter. You're only taxed, if you are taxed, in the case of tax deferred accounts, when you take money out. It doesn't matter what happened in the account along the way. It's just taking the money out that matters. And then Roths and HSAs, generally not taxed unless you get a penalty or take out money prematurely or something. So regular brokerage accounts, the big difference is anytime you sell something in one of those accounts, you potentially or you do trigger off a taxable event. Now, whether or not you have to pay tax is a different story, but the mere fact that you sold something during the course of the year, whether it was January 1st, December 31st, or anywhere in between, there could be tax ramifications of that sale. Same thing with when you get dividends paid to you on stocks held in a regular brokerage account. Those dividends are considered taxable income in the year you receive them. Interest is the same way, just like when you get interest on your checking, savings, or certificate of deposit accounts. That interest, when you get it, is taxable in that year. Unlike in an IRA or something, that interest just goes in the account and stays in the account, and you're not taxed on it in that year. That's the important distinguishing factor to know about regular or normal brokerage accounts, is you're taxed as the stuff happens, or in the year of the stuff happening. So anyway, so tax loss and tax gain harvesting will only apply to those regular brokerage accounts. Nice, people from all over the country today. Welcome, everyone. Okay, and so that's regular or normal brokerage accounts. The other thing to keep in mind is when you do sell something in those accounts, whether it's a stock, a bond, a mutual fund, whatever, it depends how long you held the position. If you've held the position for 12 months or less and sell it, and you sell it for a gain, meaning you bought it for 100, sold it for 110, whatever. If you only held the position for 12 months or less, it's called a short-term gain, short-term capital gain. And that gain will be taxed at your ordinary income rates. So that income from that gain is just slopped on top of your wages or your interest or your pension or whatever, your normal sources of income, and taxed as if it's one of those. If you instead hold the position for more than 12 months and you sell it for a gain, that is a long-term capital gain. And the big benefit to long-term capital gains is they are taxed at lower rates than your ordinary income tax brackets of 10, 12, 22, 24, 35, 37%. So that's really where there's some magic and some planning opportunities in investing in and selling positions held in regular brokerage accounts, is that if you hold them for more than 12 months and sell them at gains, at a gain, they can be, or they will be long-term capital gains and taxed more favorably. With that said, I would like to share with you the long-term capital gain tax rates. Just give me a second here. Okay. So there's 3 long-term capital gain tax rates. It's either 0%, I guess you can't say 0% because 0 means nothing. So it's either 0, 15%, or 20%. And the which one of those percentages will be on your particular long-term capital gains is dependent on how much other taxable income you have. So let me show you these here. This is for 2020, and these things can index or do index or change every year. So for 2020 at least, if you are a single tax filer and your taxable income is up to and including $40,000, any capital gains that are part of that $40,000 of taxable income will be taxed at 0. If you're married filing jointly, it's doubled. It's up to $80,000 of taxable income. Any long-term capital gains that are inclusive or that are included in that 80 grand will be taxed at 0. And then you go over those thresholds. If you're single, it's $1 over $40,000 all the way up to $441,000 and change. So very wide bracket, wide threshold. Any capital gain included in this 40,000 to 441, blah, 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 will be taxed at 15. And you can see the levels here if you're married. Not double, not even close to it. You go from 441 to 496. And then anything over those thresholds, your long-term capital gain is taxed at 20. So stick with me. I'm sure some of you are thinking, well, what if I have a gain that straddles, the 40,000 threshold? Some of it's in the 40,000, some of it's over. How's that taxed? I'll get to that. That's where I did some second grade creative construction paperwork to layer in some color on top of my otherwise black and white slides. It was a fun day today with scissors and construction paper. Seriously, like elementary school, I was eating glue sticks and everything. Just kidding. I was not eating glue sticks, although I did as a kid at times. So those are the tax brackets for long-term capital gains, and it's just important to know that they're lower than regular income tax because that all plays into what we're talking about today, or what we will be talking about today. All right, so let's start with tax loss harvesting. In a nutshell, this is just basically when you have other gains, taxable gains for the year, you can consciously sell some of your positions at a loss, where that loss will offset some of those gains and therefore reduce the amount of total net taxable gains you'd otherwise have hitting your tax return. So you may ask, well, why would I want to sell something at a loss? Well, you can think about it like this. Like maybe you've had some stock for a while, or some bond, or some mutual fund, whatever, it doesn't matter what it is. And it ended up being a dog. It dropped a lot, whether it was because of management changes or some sort of big macroeconomic change, or who knows. Whatever the reason, that position dropped significantly, and chances are, you suspect it's going to stay there. There's not a lot of upside for it to ever come back, so you got this loss. you can either just tap out today and sell it, or you can wait and just sit on that loss and wait to harvest it for if and when you have other positions that you sell at a gain. Because if you sell something at a gain, you'll have to pay tax on it, potentially 0, 15, or 20% tax. You can help reduce the amount of gain subject to tax if you wait and sell, aka harvest, that losing position in the same year that you would otherwise have that taxable gain. Because the way taxation of gains and losses work is basically you take all your short-term capital gains and losses, you net them together. You take all your long-term capital gains and losses, net them together. You take those two nets, net them together, and then you're going to have a net gain or net loss for the year. So, if you have a bunch of gains, you can go ahead and realize or harvest some losses that'll now reduce the amount of gains you otherwise have, and therefore reduce the amount of gains that are going to be flowing into your tax return. At a high level, that's tax loss harvesting. You don't, or you're not limited to only taking like a loss on a stock and offsetting that against a gain on a stock. It's basically any capital asset. So if you have like a rental property, for example, and you choose to sell it or have to sell it or whatever, and you have a gain on it, so you bought it at $100,000, you're selling it at 130, you have a $30,000 capital gain that you're going to have to pay tax on in that year. Well, maybe you have this dog of a stock you bought 10 years ago that's down a lot. That's down $20,000 from where you bought it. You can consciously now, in the same year that you have that real estate sale, you can go ahead and finally unload and actually sell off that loser of a stock. So you have that $20,000 loss that will help offset that $30,000 gain on your real estate. Net, you're going to end up with only a $10,000 net taxable capital gain that's going to hit your tax return that year. So that's the gist of it. Obviously, no one likes having positions at a loss, but it's a fact of life. Things happen. They can't all be winners. But you can help control, for tax purposes, when you realize some benefit of that loss. Don't let it go to waste. You can pair it off against a gain. That's the soup and nuts of it, or nuts and bolts of it. Yeah. The other thing to keep in mind. I'll just see a comment here. Yeah, right. So Cody's commenting that taxable income is after claiming the standard deduction or itemized. Yes, you got a bit ahead of me. That's going to be the color construction paper flip chart I'm going to have, Cody. Thanks for stealing my thunder. But yes, excellent point. And I'll bring that up when we talk about tax gain harvesting in a little bit. So let's assume that, or what if you have more loss than you do gain for a year for whatever reason, whether it was a conscious loss or not, or who knows, whatever. Let's say you end up with $10,000 of net capital losses from investment activity for the year. You have no gains to offset them against, or you already offset all your gains, let's say, and you're still left with a $10,000 deficit, net loss for the year. What can you do with that? Well, federally, the federal government is nice enough to let you offset up to $3,000 of that against your other ordinary income. So if you have wages of $100,000, let's say, and you have a net capital loss of $10,000, you can use $3,000 of that to basically reduce your wages to $97,000. So you're only going to have $97,000 of taxable income. The other $7,000 of net loss that you could not use because you were capped at only deducting $3,000 from your other income, that will carry over indefinitely, or till you die, technically, not indefinitely. Or maybe you're a vampire and live forever, in which case, sure, it'll carry over indefinitely. But so, it's not lost. That $7,000 net loss that you couldn't use, you simply just carry it forward to next year. So next year, whether you have a bunch of gains, then you can apply that $7,000 lost against it. Or maybe next year you have no gains, you can then take another $3,000 of that $7,000 carryover and deduct that $3,000 against next year's other forms of ordinary income like wages, pensions, whatever. So you can keep carrying it over and using up to $3,000 of net loss every year until you deplete and use up that carried over unused amount. So that's fairly generous, I guess, of the IRS. So that's federal. States could all be different. In most of these discussions in the group, in these lives, I'm inherently talking about federal taxes, unless I specifically mention this is about state or whatever. Not because state taxes aren't important, they are, but there's potentially 50 different forms of, well, some states don't have income tax at all, but let's call it 40-ish, different tax regimes throughout the states, and I can't possibly cover or speak on all of them. So for the most part, we're just talking about federal, but to the extent you live in a state that has state income tax, obviously you also need to consider state taxation when you're making any sort of decision. Now, generally speaking, state taxes will be smaller than federal taxes, so don't let state taxes alone drive your decision making when you're doing any sort of tax planning or tax driven investing or whatever. Keep in the back of your mind, but it's the federal taxes that are obviously larger because in almost all cases, if not all cases, because federal tax brackets go up to 37% currently. State brackets, depending on the state, it's typically single digits. Some get a little over the 10%. Maybe some go much beyond that, but to my knowledge, I think typically state taxes are within 10%. In most states, at least. I think California may top out a little higher, but anyway. So states are different. Like New Jersey, for example, how I said federally you can use up to $3,000 of net loss against your other income for the year. New Jersey, for example, doesn't let you use any net loss against your income. It's just lost, period. Like there's no carryover, there's no whatever. So kind of jerky. New Jersey isn't a very kind state when it comes to tax provisions, and it differs quite dramatically from the federal rules in many cases. For example, not to get off track, but like New Jersey income, they'll let you deduct 401k contributions, but not any other form of retirement plan. So if you have a 403b, you're a teacher, you cannot deduct your 403b contribution from New Jersey tax. You cannot deduct HSA contributions. So New Jersey's kind of jerky with that. Anyway, one other thing to keep in mind with tax loss harvesting. David asks, does the surviving spouse get a stepped up basis on does the surviving spouse get a stepped up basis on capital gains when the first spouse dies? I feel like I should know this off the top of my head, but I'm stuck for a second here, David. I don't know. I guess it depends how you own it. If you own it jointly in a joint tenants with rights of survivorship account or something, I don't know. Maybe not. Maybe in that case, because you already own it jointly. It probably also depends if you live in a community property state or not. I'm not sure, David. The answer could be maybe, maybe not. It depends on the circumstances, is my guess. I'd have to look into that, but that's a good question. I don't know off the top of my head, David. Mavis asks, who keeps track of the unused losses that are carried over from year to year? An honor system? Yeah, what? An honor system backed up by the tax form of the year of the loss in case of audit? No, so not the honor system. It's on your tax return, Mavis. So when you do your return, whether it's TurboTax or whatever, and you fill out the Schedule D, that shows your total capital gains or losses for the year. To the extent there's a net loss, it is tracked. It'll show, okay, you have a 10,000 net loss. 3,000 of it can be used up this year to deduct against your other income. 7,000 carries forward. Now here's the rub. If you do your taxes yourself or you go to the same preparer every year, that system or he or she will have this info automatically feed over to populate into the next year's return, so you don't just like lose that $7,000 carryover that you should have had. Not everyone's diligent with the record keeping, and some tax preparers, if you switch tax preparers, the one you had your taxes done last may not give you the carryover form, like a return. It's not required to be filed with the IRS, I don't think, but it's basically like an attachment, an informational attachment to the return that says, here's our carryover figures for the next year. And the whole purpose is, if and when you go to someone else, they can look at that carryover sheet. It's not just this loss that carries over. There's other things in the tax return that may be eligible to carry over. So there's a sheet that usually summarizes that. So if you switch return preparers or you switch software if you do it yourself, you definitely want to pay attention to, were there any carryovers from the prior year that I want to make sure I account for, because you may be otherwise cheating yourself out if you don't. But yeah, good question. I mean, it is in the tax return, Mavis. It's not just like, oh yeah, let me write this down on a sticky note and make sure I keep it in mind for future reference. It should all flow through tax return to tax return. Right. So Mark, and this sort of jogged my memory a little bit. So Mark says, this is going back to David's question. If it's jointly owned, if the property is jointly owned, the surviving spouse gets 50% step up. Yeah, that sounds familiar now that you say it, Mark. So assume, married couple owns a bunch of shares of stock that were bought for 100 grand. Now they're worth 200 grand. If one spouse dies, the surviving spouse basically has a half interest. You basically split those total shares in half. Half those shares were deemed to be the surviving spouse's original purchase, so they'll carry the original $100 basis, or 100,000, whatever I said, the original $100 basis. So there'll be 100 of unrealized gain. The 50% they inherit from the deceased spouse, that will be stepped up, so that basis is now $200 in the hands of the surviving spouse. Thank you for that, Mark. That yes, sounds familiar. I don't know if it changes to community property. That always trips me up. I need to go back and revisit community property states. There's only 9 of them. So anytime one of those states come into play, I need to stop and look into it again before I say something. But David, I believe that should answer your question. So thanks again, Mark, for bringing that up. Okay, so one other thing to keep in mind with tax loss harvesting is something called the wash sale rule. A little technical, but the point is, if you sell a position at a loss in a brokerage account, regular brokerage account, and you buy back that same position or a substantially similar position anytime between 30 days prior to your sale or 30 days after your sale, so it's a 61-day window basically, 30 days, day of the sale, another 30 days. So when you sell that position at a loss, you can't buy that same security or a substantially similar or substantially identical, I think is a technical word, security within that 61-day window. If you do, you are disallowed from using that loss to offset your gain or to offset your other income for the year. But not all is lost. If your loss is disallowed because you engaged in a wash sale, i.e. buying back that same security within that 61-day window around the date of your sale. If your loss is disallowed, it's disallowed for that year. That loss basically just gets added to the basis or purchase price of that new security you purchased. So, for example, you sold stock ABC for a loss of $10, but then 10 days after your sale, you bought stock ABC for a price of $100 per share, let's say. That $10 loss you had on your sale is disallowed. You can't recognize it this tax year. So it instead reduces your purchase price of that new share you bought from being $100. It gets reduced down by 10. So now you can pretend as if you bought those shares at $90. So when you do eventually sell those new shares, your starting point or your base, no, I said that wrong. Other way around. It'll add to your basis. So if you bought the shares for 100, that $10 disallowed loss will add $10 to your assumed purchase price such that it'll be like you bought those shares for $110. So then when you eventually sell those shares down the road, your gain will be based off of the assumption you bought those shares for 110 as opposed to only 100. That's where you're making up that $10 loss that you got disallowed. You're eventually sort of getting it back by reducing your future ultimate gain in that sale. A little confusing, I know, so don't get too hung up on that. The important thing is, if you sell a stock, bond, mutual fund, whatever, in a regular taxable brokerage account and you sell it for a loss, do not buy it back 30 days prior to your sale or 30 days after. If you do, it's a wash sale. Not at the end of the world. It's not illegal. You won't get arrested or whatever. But on your brokerage statement, most brokers are fairly good at tracking this. Assuming the activity all happened within the confines of your account with them, it'll report on your 1099 at the end of the year. Here's your sale proceeds, but guess what? This much of it was a wash sale. So you plug that into your tax return software. It does the math for you, whatever. You're not going to get in trouble. It just means your loss is disallowed for that tax year. Sounds scarier than it is. Anyway, that's a wash sale. Other things to keep in mind with the wash sale, it's not just when you buy shares or mutual funds or bonds, it's when your spouse buys as well. Anything he or she buys will also be considered a wash sale if it syncs up within that 61-day window of when you sold that same thing. Or if you own any companies, corporations, any purchases that corporation makes within that 61-day window will also be considered for a wash sale. And I forget the exact details, but If you buy that same security inside your IRA or some tax deferred vehicle, the IRS looks across your different account types and says, okay, you sold it for a loss in your regular brokerage account, but then a few days later you bought it in your IRA. That's no good. We're still going to have to disallow that loss in your brokerage account and call it a wash sale. Again, not the end of the world. It's a little more work for your tax return, but it's not like you don't get arrested, you don't get fined or anything like that. So that's wash sale. Good enough. All right, so that's it for tax gain harvesting. Any questions? If so, drop them in. I'm sorry, that was tax loss harvesting. That was it for tax loss harvesting. Tax gain harvesting now. High level explanation is because there are these favorably low tax rates of 0, 15%, or 20% on long-term capital gains inside regular brokerage accounts, you can look for years of exceptionally low income where you may be able to take advantage of this 0 long-term capital gain tax rate. Now, if you look, these taxable income levels are really low. $40,000 for a single person, $80,000 for a married couple. If you're working and have wages, it's going to be hard to stay under these. But for retirees, this definitely comes into play, especially that sort of sweet spot of tax planning window. The hypothetical scenario of you stop working, late 50s, early 60s, whatever. Your wages go away. You do not yet start Social Security. Assume you don't start your pension. Assume you don't have any annuity that you turned on. You, in theory, have 0 income for those years. Maybe you have some dividends and interest trickling in from a brokerage account or your savings account or whatever. But presumably that's a few $1,000s maybe in most cases. So you can have potentially tens of thousands of dollars of wiggle room in your taxable income bucket that you can help fill up with some capital gains to get these low, potentially 0 tax rate. That's tax gain harvesting. So it's consciously selling positions at a gain from your regular brokerage account when you have years of really low other sources of taxable income, because you can get some, if not all, of that long-term gain to be taxed at 0% potentially, which is good because otherwise it's going to be 15 or 20% down the road. Now 20%, most people won't hit that. That's when your income's over, $400,000, $500,000. So practically speaking, most people will be paying 15% capital gains on the majority of their long-term capital gains. But it's possible to jam some into that 0 bucket. That's tax gain harvesting. Let me show you an example here. All right. So this gets back to Cody's point in my original comment that the 40,000 and 80,000 thresholds for under which you pay 0 tax on long-term capital gains is your taxable income threshold, not gross. Most other things in the tax world are based on gross income or modified gross income, aka Maggie or Maggie, depending who you ask. Let me pause that handful of questions here. Suzanne asks, are you aware of any capital gains tax changes that would affect this topic in the next few years? Great question, Suzanne. This particular topic, I don't think so. Step up in basis, definitely. Not to get too off track, but that basically means if you do have these unrealized capital gains that would otherwise be taxable if and when you sell them, as the law stands now, if you die and is it bequest? Is that the technical term? If you die and pass on these positions to your heirs, that accrued unrealized capital gain magically goes away, and your heirs inherit these positions on the and their basis, the assumed value they paid for them will be whatever these things were worth on the date of your death. So that whatever gain there was, boom, gone. So your heirs now start fresh with inheriting it at the price it was when you died. That's called step up in basis, because the basis, meaning the price you paid, gets stepped up to its value on your death, so that your heirs basically bought it, or it's assumed they bought it at the value on your death. One of, I'm not making this political, just stating the fact of what we know now, one of Biden's proposed, one of the main tenets of his proposed tax plan is to get rid of or at least reduce or otherwise change the step up in basis. Now, there's not enough detail to know how it will actually play out, if it will play out at all. That first assumes he gets elected. It first assumes there's more Democratic presence in the Congress, and then it further assumes that they actually get some tax code changes in place and voted on and approved. So there's still lots of things that can change, but nonetheless, removing step up in basis is definitely one of the key points of Biden's tax plan. So that may change. But the taxation of long-term capital gains while you're still alive and you sell it, I don't think there's changes. Not to say there won't be, but as proposed now, I don't believe that's a flashing light on any politician's radar or proposal, to my knowledge. I could be wrong, but I don't think so. Great question. Mavis asks, transactions inside of 401k are not subject to wash sale rules, correct? Question mark. And then I see Derek says, not usually, but they are generally subject to their own short-term trading restrictions where you can actually be penalized for trading restricted security. Yeah. Bequeath. Yes, thank you, Derek. So it's not bequest, it's bequeath is the legal term for leaving something to someone. I bequeath this to you on my deathbed, or after my deathbed, I guess. So Mavis. Yes, so I think Derek's right. Strictly within a 401k, no, there's not wash sale rules because there is no tax deduction or gain in the year that you sell stuff. It doesn't matter. Whatever happens in that tax shell just stays there. It's when you take stuff out that you're taxed. Yes, as Derek points out, the administrator can bestow upon you restrictions that they don't want you flipping in and out of mutual funds every month, every 3 months, whatever. So they can put restrictions on that. But where there may, I don't know if this is what you're asking, but like I mentioned before, what you trade in your 401k may trigger a wash sale for something you sold in a regular brokerage account, potentially. Like if your 401k has an S&P index fund that you invest in, and you also own an S&P index fund in your regular brokerage account, and you sell that fund in your brokerage account for a loss, and then you buy either 30 days before or 30 days after another S&P index fund in your 401k, I'm fairly certain that will trigger off a wash sale in your taxable brokerage account such that you will not be able to deduct the loss on your S&P index fund in your taxable brokerage account. Fairly certain that's how it works, Mavis. But strictly within the confines of your 401, no. Tax loss harvesting doesn't matter. Wash sale rules don't matter, just like they don't in Roths or HSAs, because there is no current year tax impact of buying or selling stuff within there. Good question. All right, so let's go through an example how this taxable income stuff works. And this is where the color comes in. This is with the construction paper and me eating paste earlier today. So this is assuming a single person, just to keep it simple. The first $40,000 of taxable income, the long-term capital gains within that 40,000 bucket will be taxed at 0%. This is not the scale, obviously, but then from 40,000 all the way up to 441,000 and change. Any long-term capital gain within that band of taxable income will be taxed at 15%. And then if your taxable income is over that level, again, these are for single people in 2020, any portion of long-term capital gain above that taxable income level will be taxed at 20%. So let's walk through an example. Let's assume you have no other, you recently retired, your wages stopped, you turn on your pension, you're single, you get exactly $40,000 of pension income for the year. That's this red bar right here. So you may say on the surface, oh, junk, that filled up right to 40,000 bucks. That filled up my first threshold. So now there's no room for any long-term capital gains on there. And capital gains stack on top of your other income. So if this 40,000 fills up this bucket, any capital gain you have will just bloop, will sit right on top of it. So you may look at this and be like, oh man, I filled up the bucket with my 40,000 pension. But as Cody pointed out, and this is what I was saying, hold this thought for a while, it's taxable income is what this threshold is, not gross income. So let's assume you're single and you take your standard deduction. I'll assume you're under 65. So your standard deduction for 2020 is $12,400. So this is your gross income. Subtract from it the $12,400 standard deduction. Look at this. This is top-notch production quality. Now your taxable income is only $27,600. Again, the math is your $40,000 gross income of pension minus the $12,400 standard deduction, and you're left with $27,600 of taxable income for the year, right? So that's it. So you have this much room, you have this much hole to fill up until you hit your $40,000 of taxable income top, your cap. So perfect opportunity to go out and harvest yourself a gain in your brokerage account to the tune of, look at this. This is magic, this stuff right here. Production quality is off the charts. You go ahead and consciously sell some stuff. You can't quite read it, sorry, because of the blue paper. You have a $12,400 realized long-term capital gain this year. Boom, stack that on top of your $27,600 of other taxable income. Now you fill up to the penny this $40,000 taxable income threshold. So that means any long-term gain sitting inside this threshold is taxed at zero. So this $12,400 long-term capital gain you just harvested will all be taxed at zero. Magic. That's tax loss harvesting. Now rewind a year ago. Let's say I don't have a pretty piece of paper for this. I should have. I'll use this hot dog stapler as a piece of paper. Let's assume this represents your wages. Look at this. That's cool. From my kids. I get great stuff. Let's assume this was a year prior and this represents $200,000 of wages. Overlay this on the bar. Boom. You're all the way over your 40% threshold. So if you were to stack any long-term capital gains on top of this hot dog, it's going to be taxed at 15%, simply because this is filling up this lower bucket of taxable income. This is your wages. But now come back to present day. You retired, your wages stop. All you had was this $40,000 pension. But again, that's a gross income figure. Subtract out your standard deduction. That leaves you this much room to fill up with this blue long-term capital gain. Just like that. What otherwise would have been a 15% tax on this gain had you sold it a year prior is now only 0% or zero, because you're filling it up, you're keeping it under this 40% taxable income threshold. Now, common question I get is, okay, what if, either by choice or not, I don't precisely sell and realize $12,400 of long-term capital gain, but instead I get $20,000. Again, I'm so proud of myself with these graphics right here. Wish I could straighten that out. So that stacks on top of your $27,600 of other taxable income. This now, if you notice, puts you over, draw a line through it, puts you over this $40,000 threshold. So common question, is all this now taxed at 15? Thankfully, no. This gets bifurcated. The part of it that is underneath this 40,000 threshold is taxed at zero. The portion that's over, which is what, $7,000 something dollars, is taxed at 15. So your long-term capital gain tax does get bifurcated based on where that capital gain lies relative to these thresholds. And then let's take this out even further. Let's assume you had a $500,000 capital gain. That would take you all the way up to somewhere up here. Point is, over this threshold, the way it would work is some of it, the first $12,400 would be taxed at zero. The next $401,450 would be taxed at 15, and any portion of that gain, incrementally above that, would be taxed at 20%. Everybody good? The magic of my second grade construction paper project hopefully makes some sense of this. All right, let's see. Man, that was good. I was looking forward to that all day. I was really psyched about these little squares of paper I was cutting out. 42-year-old man playing with construction paper. I love it. All right, let me just stop and see some comments. I have a couple other comments to make about tax gain harvesting. Cody Garrett with a gif of a dude wearing a unicorn shirt. I need that shirt. Great post, Cody. Jackie likes my graphics. Awesome. Thank you, Jackie. Derek says he does not believe wash sales apply to 401k. At least Ed Slott says so, but I can't find a revenue ruling or private letter ruling stating as such. Okay. Cool. If you want to take that homework upon yourself, that would be awesome, Derek. Possibly that's the case. I don't know. Logically, I know in IRAs it counts. So by extension, I would assume that it counted in 401ks. It seems logical that it does. If it doesn't, awesome. Good for everybody, good for the investing public. I could very well be wrong with that. So if I am, apologies everyone. perhaps 401k activity does not apply for Washdale rules against your regular brokerage account. Mark says Biden proposes to tax capital gains at ordinary income rate. Right, yes, that's right, Mark. Yeah, Mark's doing a great job of prompting, jogging my memory. So I did post last week or earlier this week Biden's proposed tax plan from Tax Foundation. It was like 6 or 7 points, and that's right. That sounds familiar, Mark. He does propose taxing capital gains at regular income, but only for people who have $1 million of other income or wages or something. I don't remember. The point was that, he wants it only to apply to high income earners, not everybody. So most of us, for better or worse, won't be having $1 million a year of income, so it won't apply if that even passes and comes to fruition. Mavis thinks the hot dog should make a cameo in a future session. Thanks. I'll try to find some way to work that in a creative way, in everyone. Pixar will be jealous. Thanks. The hot dog is the mascot. Terp dog. I like that. Good one, Marianne. Thank you. Okay, so Cody. Right. So Cody's saying, be careful that some income from taxable brokerage accounts include interest, dividends, capital gains, can be distributed at the end of the year. Exactly right. So whenever you're doing tax planning, whether it's Roth conversions, Roth whatever, and you're trying to really fine tune your income right up to a certain level or certain tax bracket, especially if you have a brokerage account, you always want to be careful about getting caught by surprise by getting stuffed with interest or dividends or capital gains that you didn't consciously elect to have. Interest is pretty straightforward. If you have any banking products, you get interest. If you have any fixed income or bonds, government bonds, corporate bonds, municipal bonds, there will be interest. Now, municipal bond is usually tax-free, but whatever. Point is, equities, stocks don't pay interest. If you own a bond, they will. So you'll presumably know you may have some interest. Mutual funds are many of them are really tax inefficient in a regular brokerage account because, not all mutual funds, but actively managed ones, index funds less so, but actively managed funds where the fund managers are buying and selling things within the fund throughout the course of the year. That buying and selling is internally creating capital gains or losses within the fund. Even though you're not telling the fund managers when to buy and sell the stuff within the fund, those gains and losses still get passed on to you, the mutual fund owner, nonetheless. And it usually happens in December. So you'll get in your tax return, your 1099, it'll show up, hey, guess what? You have $2,000 of capital gain for the year in this mutual fund. You'll be like, what? But I didn't sell the fund. I hold the whole year. Doesn't matter. It's the stuff that's turning over inside that fund is generating gains or losses. Those get passed on to you, the fund holder. So especially if you have a lot of mutual funds, you can get stuffed with tens of thousands of dollars of capital gains that you didn't plan on having. Guess what? Boom, you get them dropped on you in December. So that can really mess up your tax planning if you're trying to get cute and cut it real close to these certain thresholds. Keep that in mind. That's why if you look at my mutual fund versus ETF video and summary I did, ETFs are generally much more tax efficient for a few reasons, one of which is they don't have a lot of active trading inside of it, and the way they distribute things out if they need to make redemptions or something, they typically don't pass on gains to shareholders, whereas with mutual funds they do. As other people sell out, the fund may need to sell stuff to generate cash to pay that person out. Selling that stuff means you, the remaining fund holders, may get stuffed with some capital gains. Anyway, I got a little carried away, and that may have been more technical than necessary, but Cody brought up a good point that if you have stuff in a regular brokerage account, be prepared to get some gains, dividends, or interest that you may not have been planning on getting distributed to you during the year that will be taxable income for you. David says, if you are getting Affordable Care Act subsidy, taking a taxable gain may result in less subsidy. Yes, exactly, David. So these are all, even if the gain may not be taxable or is, even if the gain is taxable or even zero taxable, it's still part of your gross income nonetheless. So for purposes of a lot of other things, like I said, those are keyed off of gross income, not taxable income. Affordable Care Act premium subsidies is one of them. So if you have capital gains, even if they end up getting taxed at zero, those capital gains still add to your adjusted gross income, which could reduce or even knock you out of eligibility for getting the Affordable Care Act subsidies, which could be quite juicy, depending how low you can keep your income. Great point, David. Okay, Cody chiming in some more about mutual funds distributing gains. Lori say, yes, one reason to hold individual stocks. Good point. When you own individual stocks, you control when you buy or sell them. There's not going to be any surprise, unwanted gains happening because you're the one who sells them. The downside, obviously, is individual names could be potentially risky. So unless you're building a portfolio of, tens or more of stocks, if one stock goes skunk on you, that can really mess up an otherwise what was an otherwise healthy portfolio. But yes, that's one of the upsides. You completely control when all the gains and losses happen. Jeff saying, too bad we lost the Roth undo. Correct, yes. So Roth conversions are a real big thing, and we talk about it daily in this group. Up until like 2 years ago, you used to be able to what's called, is it recharacterize? Unconvert? I'm drawing a blank on the name. I forget the technical term, but you used to be able to unconvert when you did a Roth conversion. So the tax planning used to be much easier. At the beginning of the year, you can just, lick your thumb, stick it up in the air, take a guess. I think I'll probably need to convert like 50 grand this year. Let me convert a little more just in case. I'll convert 70 grand. And then as the year progresses and you get towards December and you have a better picture of what your actual income is going to be, you can undo some or all of the conversion you did early in the year and basically back it out. So you can really drill down to the dollar of how much money you can convert, and you can do that after you already know your income for the year. Well, that got taken away. You can't undo a conversion. God, it just bothered me. It's not recharacterized, or maybe it is. It's undo. Functionally, it's undo. You cannot undo conversions anymore. Yeah, it is. Okay, so Cody says it is recharacterization. All right, cool. So yes, we don't have that option anymore. So before you do conversions, you got to really plan ahead and not overdo it with conversions because you don't want to risk over-converting and jacking up your income too high and knocking you out of eligibility for stuff. All right, good. So one other thought about tax gain harvesting. Unlike tax loss harvesting, which is selling losers to offset winners, tax gain harvesting is not selling winners to offset losers. It's selling winners when you otherwise have low income to pay low tax on those winners. That's sort of a fundamental difference. I had someone ask once, I have a bunch of accumulated, unused, long-term, gain that I've been carrying over, and I can only deduct $3,000 every year against income. I don't have other gains. Could I or should I go ahead and sell something at a gain to have that gain offset some of this unused loss I keep carrying over? And my answer was no. And I think in most, if not all cases, the math answer, the sort of quantitative answer should be no, because it's not bad to have this unused gain you're carrying over, because every year, at least federally, you're taking $3,000 of it and deducting it from your other sources of income. So you're reducing your ordinary income tax bill or ordinary income taxable amount by $3,000. And because ordinary income tax rates are higher than long-term capital gain rates, it's good to have that $3,000 loss reducing your ordinary income tax. You do not want to instead go ahead and sell something that's at a gain to offset your loss, because that gain would otherwise be taxed at 0, 15, or 20%, not potentially up to 37% if it was ordinary income. So don't use up your losses don't sell something at a gain to try to use up your losses, because you're saving yourself less tax than if you just keep using those losses to offset your ordinary income. I feel like that wasn't a clear explanation. Hopefully it made sense to at least some of you. But point is, tax gain harvesting isn't trying to sell winners to offset losers. No, it's selling winners, paying the tax, but when you have low taxable income years, so you can ideally try to get into that 0% long-term capital gain tax rates on those gains. One final thought. So you may be asking, okay, fine. So you're telling me I could or should sell a position at a gain because I'm in a low income year. So let me take advantage of the tax. But what if I like that position? I want to keep holding it, right? I've held it for a long time. It's done well. I have a positive view going forward. I don't want to get rid of it. No problem. You don't have to get rid of it. The day you sell it, that sale triggers off taxable gain that you now run through this $40,000 threshold, whatever. You can immediately buy it back that same day. It's not like a wash sale with a loss where if you sell something at a loss, you can't immediately buy it back. If you do, that disallows the loss. With a gain harvesting, you can. So you can sell something at a gain, pay low tax on that gain, immediately buy that something back. And the beauty of that, you still own the position just the same, so you didn't actually get out of the position, if you will. You did what's called, you reset your basis. You originally bought this shares at, let's say, $10 a share. You sold it today, harvested and realized some gain. You immediately buy it back at, let's say, $20 a share. Well, guess what? Any subsequent gain in the future is now based off of the price increase from $20, whereas it was originally the price increase from $10. So you took some gain off the table, paid low tax on it. You're still in just the same amount of position, but now you have less taxable gain going forward because you reset your basis. Make sense? Hopefully that was clear. All right, that is it for tax loss and tax gain harvesting. I do have videos on both if you haven't seen it. The tax gain one just came out this past week. Tax loss has been around a month or two. But nonetheless, they're both there on YouTube. If you want to see the more formal scripted, you can see this in not as glorious colors on the YouTube video. So that's that. Looks like there are no other questions. So we will wrap it here then. I will see you next week. Next week's topic, I believe, is the various exceptions to the 10% early withdrawal penalty in IRAs, of which I think there's like 9 of them, give or take. So we'll be walking through that next week. All right, take care. Thanks for joining. I will see you next week.